Chapter 18 deals with mortgages, and I think it's a very important chapter. I mean, it goes along with, I think the past three chapters have been very important with the stock market, the bond market, and now mortgages. So basically, a home mortgage is a loan that we get on our houses, on real estate. And in today's market, they go 15 years or 30 years. So they're more of a long-term mortgage, hopefully with lower rates, and your house serves as collateral. The textbook talks a little bit about the history of the mortgages, which I think was very interesting. So it says, when we go back to say like the before World War II, so around the World War I time, only about like 45% of Americans actually owned their own home. So how the banks worked it is you had to have 50% down. So that's, you had to be able to buy half of the house. Then they would loan you for 5 years. And then if you couldn't pay it off in 5 years, you could refinance another 5 years. But then you always ran the risk that the bank maybe would not refinance you after those 5 years. And then you would have to sell it. So that's a whole different type of a market than what we are used to in today's world. Then they said, after World War II and, the Great Depression, things kind of started to change a little bit. The house and as we push that forward up to today, the housing industry is really a huge piece of our economic market. It gives statistics to say that the housing sector accounts for about 15 to 18% of the entire U.S. economy. So if something goes awry in that market, which can happen as a result of changes in these mortgages, that can be a huge deal. So basically, some basic concepts about the mortgage. Banks require you to have a down payment. Normally they like to see 20% equity. So either you put 20% down or you're buying it at a price that's really, really good. So you've got some equity already built into it. But they want their loan balance to be basically 80% of what that house appraises at. So if you don't have that, so in today's world, if you don't have that, what they will give you is private mortgage insurance, which sometimes is abbreviated PMI, and that is added to your monthly payment, and that's protection to the bank. So that says that the first 25 to 30% of the amount, like if you were to go into default, they had to foreclose on that mortgage, the first 25 or 30% is going to be covered under that private mortgage insurance. So again, they're protected. So ultimately the bank who's given you the mortgage is protected from losing that if you were to, go into foreclosure. But then you as the person is paying that. And like when my husband and I got our first mortgage, we had 10% down. That's what they required at the time. And, we had good credit. We both had jobs. We didn't have any bad credit. We were young. And they did have us do private mortgage insurance because we didn't have the whole 20%. So then what they did though is after a certain period of time, I could contact them. I think I want to say it was a year then. Maybe it was 2 years though. So after 1 or 2 years, I could contact the bank, have the house reappraised, and they would remove that private mortgage insurance. So then that's what I did. So I think we only paid private mortgage insurance for a year, maybe 2, because to me it was like a waste of money. You know what I mean? It's just money that I know we're not going to foreclose on this house. It's protecting the bank, not us. And I wanted that off as soon as I could get it off. But I have some friends who bought a house, and it was a kind of probably a more expensive house than they could afford really, but they had to get private mortgage insurance, and it was for 10 years. I mean, that's a long time to pay. And in theirs, again, because it's a more expensive house, it's $100 a month. $100 a month they're paying for that private mortgage insurance, which is kind of crazy. So just be careful. I mean, know that is a cost to you as the lender, and it's basically just protecting the bank. So it's not, you know what I mean? It's maybe sometimes you feel like if it's your first house, you kind of have to suck it up and do it. But I would definitely market that around to make sure you're not stuck paying it for 10 years like that couple that I know. Then there's fixed rate versus adjustable rates. Obviously, fixed rates I feel like are the best for you to lock into, especially if you know, like say right now, mortgage rates are as low as they've been in years. So if you could lock into a rate now and you're fixed for 30 years, you're set. This is my husband and I's third house, and all of our houses though we've gotten fixed rate loans, but this we bought kind of during that mortgage crisis of 2008 or whenever that was. I mean, that we bought it a few years later, but it was still the interest rates were still very low at that time. So we locked in at that fixed rate mortgage. And then you know that's what your payments are going to be for the rest of that time. Now, granted, we'll talk a little bit about escrow. That changes it a little bit. But these ARMs or these adjustable rate mortgages, normally the rates are low, but then they vary. So they may be at a certain rate for 3 years and then they're going to change. So then that's the thing, you don't know what it's going to be in 3 years. So it's a little bit more risky. I've never done any adjustable rate mortgages personally. I've only done fixed rate mortgages. Then they talk about there's Fannie Mae there's Fannie Mae right now. Then this part of the chapter, they're talking about FHA and VA loans. So the Federal Housing Administration and the Veterans Administration, they can offer some more protected mortgages, and you have to qualify for them. So there's different requirements and restrictions that they set forth. But then those normally can guarantee you a lower fixed rate as well. But there is some stipulations that go along with those. Then you can also be forced to pay discount points. And I don't know what is going on currently in the market, but there's been, that kind of comes and goes as to what it could be. And then sometimes you can get if you're the buyer, you can ask the seller to pay your points. I know that the second house that we sold, those buyers, maybe the first and the second, maybe both of them, asked us to pay their points, and it was like 3 points. So 3 points is 3% of the amount you're financing. So it was like, $3,000, $4,000. But like sometimes if that's what the market is, where all the sellers are willing to pay it, then you're somewhat forced to do it. It depends on if it's a buyer's market or a seller's market. So it kind of depends a little bit on that. But you should understand what those discount points are. And then maybe if you are in the market to buy or even in the market to sell, talk to your real estate agent so you understand what the current trend is. Are the buyers paying those points, or are they asking the sellers to pay? And then you can go through and calculate your mortgage payments. If I had required the financial calculator, I would have you do it in the financial calculator. In business analysis with algebra, there's a section of one chapter that we deal with mortgages, and we compute the payment, the principal, and the interest, and we amortize that loan. If you look in the textbook, it gives you some amortization tables, which again, like in business analysis with algebra, we would have created some of those. So it's always interesting, I think, to look at those to see, well, how much of my payment goes to interest, how much goes to principal, especially in a mortgage, because so little, when you very first get that mortgage, so little of your payment goes to principal. So, and the textbook talks a little bit about that. Like, so say if you think, I'm not going to live in this house real long term, like I'm going to, I want to transfer to a different location. I'm only going to be here for, maybe you buy, a house while you're going to college or something, and I'm only going to be here for 4 years. Those you have to be careful, because like it shows you on here, those first 4 years, you're paying so little in interest that you better hope that the market value of the house is going up, because then when you go to sell it, you've got to pay your real estate costs. You may have to pay points on the people who are buying it. Maybe you paid points when you bought it. So you want to factor all those costs of actually owning a home compared to how long you think you're going to own it, because maybe renting would actually be a better way to go. Now, if you knew for sure the market was going up, and there are times in our markets where the real estate really does appreciate in value, maybe in those 4 years, if the value is going up, you'd end up being fine. But the textbook talks a little bit about that, and those are things definitely to think about. And sometimes we don't know. Sometimes the real estate market is a questionable thing. You don't know when it's going up or going down. But primarily when the economy is going up, the real estate market goes up as well. And then it talks about 15 versus 30-year mortgage. I've had both in my lifetime. So the first house we bought, we got a 30-year mortgage, but we always paid extra. We always made extra payments on that. Then our second house, I got a 15-year mortgage because I thought that we were financially able to do it, and we were kind of used to paying more on that first house. And then now this house, I went back to the 30-year mortgage because the rates were so low anyhow, because that's normally the draw. To go 15 years, your interest rates are going to be lower than to go 30 years. So sometimes, even though maybe your monthly payments are like $300 more a month, you're thinking, well, I'm paying a lower rate and I'm going to pay it off in half the time. So that can be, that's definitely something to think about if you can afford that extra $300 or whatever the difference would be. Taxes and insurance, always factor those in. That's the thing. Like, say you're looking for a house and you're going Zillow and you're doing those things. It'll always say, hey, you can buy this house for $580 a month. And you're thinking, oh, cool, I can afford that. Well, then you're not factoring in taxes or insurance. And so they say that taxes on average is a certain percentage. It's about almost 1% of the house's assessed value. So if you have a $200,000 home, you're going to be paying $2,000 in taxes. Now, sometimes there's different things that are assessed on those taxes, so you may pay more. I mean, your school districts, when they get funding, a lot of times those are attached to your taxes. Local parks can be attached to your taxes. So you do want to check into that, but that's probably kind of a good rule of thumb average to say 1% of the value. And then those are normally paid annually or semi-annually. But when you have a mortgage, they're going to put it into escrow. So then they'll take that annual amount, divide it by 12, and that's how much you're gonna have to pay to the bank, that they'll set it aside and then pay your property taxes for you. Same with your homeowners insurance, because obviously the bank, they are the primary owners of your house. They probably own 80% of it. So they want it protected. So they're going to make sure you've got the right homeowners insurance, and then they'll also pay that. So that'll be an annual premium, maybe about $700 a month, and they'll take that out in monthly increments and put that in escrow as well. So those are things, of course, the bank does to protect themselves and make sure that you're paying it. And with our first mortgage, I asked if I could handle it by myself. That was years ago, though, and they let me. Now, in future mortgages, the answer was no. The bank wants to do it in escrow. They no longer give the homeowners the option to pay it themselves. Okay, then we get into how did we end up with the horrible mortgage crisis that we had in 2008. So, we went from, having to have 20% down, 10% down. Then we came to like 0 down home mortgages. So you didn't have to have anything, because it is tough for people to save. And then we're in an environment an economy that a lot of places don't even make you. You can go buy a car with nothing down. You can buy furniture with nothing down. So it's kind of like our thing to do is 0 down. So we started doing these 0 down mortgages so that, people could just go and buy a $150,000 house with nothing saved up. The thing that puts a lot of risk on the lender, because then it's said that statistically, if a person who could save up those 20% or probably even 10%, those people only had a 2% chance of defaulting on that mortgage. So it's the other people who have not saved anything and who got these 0 down that are really the biggest risk of defaulting. And it's because, like what the textbook says, they don't have any skin in the game. You don't have any money tied up in it. So yeah, your credit is going to suffer if you walk away from that mortgage, but you didn't lose any money. The bank is who loses. Where, if I put 20% down, I got a big chunk of money in here. I don't want to walk away from that. If I walk away from that, the bank keeps it. So that's kind of just natural, I guess, tendencies. Then it talks about these teaser arms, and that's really what got us into trouble, I think, because what they were offering during those times before the mortgage crisis, so in the early 2000s, people could get these variable rates, and a lot of them were interest only for the first 3 years. So imagine that, you're buying a house you really can't afford. the interest only piece of it is not much. You're thinking, hey, I can afford that. Well, then after 3 years or 5 years, it flips into a regular mortgage that has a higher rate of interest, and you've got to start paying principal. Sometimes that was twice as much as what you were paying. So you're used to paying, $500 a month for 3 years. Then all of a sudden, boom, one day they're saying, hey, you got to start paying $1,000. Well, no, I mean, no one can do that. I mean, that's very challenging to have people be able to do that. And what these people were doing is they were playing a game. They were thinking, well, rates or not rates, but housing values are going to go up. So I'm going to buy this house for $150,000. In 5 years, it's going to be worth $175,000. So I'll be able to refinance it because I'll have the equity, or I'll sell it. I just made some money. I lived here for $500 a month for 3 years, and I'm going to sell it and make 20 grand. And there probably was a time people were able to do that. And it talks about, especially in the markets like California, Florida, Colorado, different states where there's real high values of their real estate, those places were probably able to do that. But it's still a risk because you don't know that that's going to happen. So then what happened though with those people when this crisis happened is then they reached their 3-year ARM extension and they had to refinance it. And then the real estate market hadn't gone up. Maybe it had even gone down. So then they're looking at this house. They say they owe $150,000, paid no principal. Real estate market went down. It's worth $125,000. Who's going to pay that? They all walked away. I mean, literally all of those people walked away because who would do it? I mean, it's almost, you would just take that ding on your credit and move on, rent for a few years, and then come back at it. So that's really to me, that's what really killed the mortgage industry. And it hit those states, like I said, California and Florida, really hard because it happened a lot. And then the textbook also talks about a negative amortization home mortgage, which would be another one where you actually didn't even pay all the interest. So like if you started at $125,000, after 5 years, maybe you owned $150,000. Well, again, you're playing the market. You're hoping the housing value goes up to cover that. And if it didn't, those people would have walked away too. And then no documentation home mortgages, that's just asking for fraud. I've never even heard of those. But the textbook says that the potential for deception and fraud was overwhelming, not only by the borrowers, but by the lenders, because they were getting commission on these deals. So that just is a disaster, recipe for disaster. Okay, then it gets into, well, how did it all kind of really happen? So what happened in our markets is that we created a secondary market for these mortgages. So the initial thought is, okay, well, how do you do that? Because a mortgage is maybe $150,000, $200,000. Your mutual funds they want $2 million, $3 million. They want big numbers. So they're not going to just take a few mortgages. And then two, they're not all mortgages are the same. Every bank kind of does stuff different. Like I said, there's ARMs, there's fixed, there's variable, there's, you know what I mean? There's all different things. And then third, you'd have to do a credit check again on all of these people who have these mortgages to know, is this a good investment and not a good investment? So obviously the investing community isn't going to be real quick to jump on that. So what the government created was Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac enabled people to create, through the government, there was funds available though to kind of pool these mortgages. So you could bring them all together and then sell them. So then from there it went on to, then they said there's also a Ginnie Mae and Freddie Mac join in. But then it became more of these mortgage-backed securities. So then you could pool all these mortgages together and then sell like shares of them. So it would be like a share of stock, except for there's no company. It's just a pool of mortgages. And then it talks about, well, how did we come up with prices for those? And that was maybe where some of the problem came in as well. But then when we talk about these mortgage-backed securities, I guess there's two different kinds. There's a collateralized mortgage obligation, CMO, and then a collateralized debt obligation, a CDO. So the mortgage obligation is where lenders pool the mortgages together, and then the pool gets cut up into tranches. Then the other one, the debt organizations, is not mortgages. So that would be like businesses. And when I worked at the oil and gas company, that's how our debt was. We had, millions of dollars. Like I want to say like a $220 million debt arrangement every year. Well, no one bank is going to loan us that. So we too had it in tranches. So there might be like 10 banks that all, came in and said, okay, I'll loan them 20 million, you know what I mean? So our debt was split up that way. So big businesses will do that as well. So that's what that CDOs is the big businesses debt that are kind of split up. Now ours was specific to like specific banks. I don't know, this particular arrangement maybe could have been sold out to like investors as well. But so then that's kind of what happened though. So then they were pooled together, they were sold out as to investing people in shares. And the next section talks about these copulas, how these statistical computations were made to value them, and that's the price that people paid. And there was a time that those were doing really well. I remember when I worked at the oil and gas company in my 401k, I had a certain percentage of my money going into those mortgage-backed securities. Because at that time, that was, again, it was years ago. So it was when Clinton was in office. And it talks in the textbook too that in Clinton's years, there was a big push for people to own their own homes, that he felt that would spur the economy. So politically, there was a big push for that. Now, I switched it out when Bush took over, but initially Bush also had a push to have homeowners and to have minorities own homes, and that was a political push. So sometimes those politics can come into these mortgage, kind of all these different things and kind of give stuff a different flavor. But so then anyhow, that's kind of what happened though. During that time though, after it all kind of came crashing down in 2007, and I feel like it was just one thing after another, one state after another. But when that housing market starts to drop and people are looking at what they owe compared to what the house is worth, more and more people walk away. So then it kind of becomes cyclical. So as we led up to it, it was because we had money. There was people investing in it. These investing pools had money to loan out. The politics were pushing more mortgages. We had zero down. We had, we had all these variable rates. It was all over the place. So we're building. Then the economy slows. The first wave of those ARMs are coming due. People can't get refinanced. People are walking away all over. There's bank-owned homes everywhere. The whole real estate market goes down. Everyone's kind of, in a horrible situation. So that's kind of how it all happened. So, you just want to understand how that happens and then kind of know. And then I think we shift back, and say, okay, no, now you need to have 10% down. You need to have good credit. And we try to kind of make some corrections to the mistakes that we made that brought about that whole mortgage crisis. So it's an interesting chapter. It's a good one to read.